Welcome to CEO Money. I'm Michael Yorba. Thanks for joining us. I've got Rob Braiman, CEO of Cogent Analytics, on the show with us today. Rob, welcome to the show.
Michael, thanks for having me back. It's truly a pleasure.
All right. Briefly, give us a snapshot of what your company does for the new audience. We're getting new people every day. And then I want to get into profit engineering.
Cogent Analytics is a management consulting group to Main Street. So we represent the small to mid-market segments, privately held equity only. We've had one publicly traded company, but my passion ultimately is for the entrepreneur and the entrepreneurial spirit. So for the last 16 years, I have been representing small business owners. First, I did it with another firm. And then I turned Braiman and Associates into Cogent Analytics in 2014, and we have been on the Inc. 500 or Inc. 5000 now twice, once in the 500, once in the 5000. And I talked to my CEO yesterday, and I'd like to believe that although the reporting hasn't come out yet, but I believe we will be on it for the third year in a row. Although I got to go through the exercise next year as well. So we've had some pretty good successes and exponential growth.
Yeah, I'm sure of it. We've had a couple of conversations, and you really instill confidence in me. All right, profit engineering. Tell me about that.
So most business owners, especially entrepreneurs, tend to look at profit as a residual to all of their efforts. And what we try to do is turn it up on its head. Because if you are going to manage a company, ultimately profit has to be engineered from inception, and then reverse engineering both direct costs and indirect costs. And likely because we're doing profit engineering today, Michael, we'll get into a little bit of a geek out session. I don't want to get too technical because this whole thing turns out better when I'm on a whiteboard as opposed to just auditory response or visual response for your listeners. But profit engineering is an exercise of actually determining profit from inception instead of treating it as a residual. So it will affect your gross margin, it affects your net margin, it affects how you hire, it affects what pay raises you give, it affects remuneration from an incentive-based compensation basis. It allows you to set profit targets by margin mix management. So different products that you sell yield different levels of both gross and net profitability. So they'll have different absorption rates. You'll have different sell-through rates. But if you know that by doing the analytics, if you're operating your company by the numbers and you can develop a trend analysis around your strategy, it gives you a much better ability to navigate the waters of profit management, or as we refer to it, profit engineering.
Got it. Okay. You look at profit differently than most people, and to drill down a little bit on it, you go from a passive accounting process into a more depth and proactive, holistic approach with people's businesses. Open that up for us. I mean, you just kind of touched on the top of it, but I know there's more for you to bring out on that.
So profit engineering is going to affect absolutely every element of the business. To illustrate it, I think I'm going to focus a bit in its most simplistic concept. Most business owners say revenue less cost equals profitability. Our belief is revenue less profit equals what you get to spend. And I know I say that as an anecdotal joke, but one of the rudimentary issues that we get into when representing clients is that business owners most often will look at their P&L at the end of the month and they'll flip to that back page and they'll just see if they made or lost money. What we're trying to get them to do is not just looking at the totality of their financial statement, but the implications of things they actually have control over. When you have a business owner and he's in business and he realizes he's not making money, almost always you have two types of business owners. I need to sell more, right? Or I need to cut costs. Our argument would be you have to do both all the time.
Right.
You have to be able to either augment your market share by breaking down your products and distribution channels into different margins for different circumstance, right? So you should be strategically pricing your goods. Doesn't matter if you're wholesaling goods, if you're a contractor, if you're a manufacturer, If I was going to give you an example for a manufacturer sells 100,000 of a thing. He can be more competitive or price more competitively than if he's a job shop selling one at a time, right?
Right. Okay.
So I'll take that next step. I have relationships in my business that represent 30% of my business. I get a lot of pricing pressure from that relationship, which costs me to keep my margins aggressive. And without selling to other points of distribution or always pricing down to that lowest common denominator, what happens is you end up with a very narrow gross margin and hence a very narrow or a much narrower net margin.
Right.
So if you take the profit engineering and you were to say, Mike, I want to make 10% this year, right? That is my goal this year. I think I'm entitled to make 10% net profit, 1 penny out of every 10, $1 out of every $10, $10 out of every 100, right? I have then got to decide through analytics, what am I selling, to whom am I selling it, and how am I competitively pricing to absorb my overhead obligation, right? So that's a competitive edge based on break even. I've got to get into where I break even and then more importantly, dial that down so I see what my profit contributors are and how I stratify my costs against the different types of margin that I'm creating and different volumes at what margin I'm creating. Now, I told you it's going to be a little bit of a geek out session, so if you have some follow-on questions, I understand.
Okay, that's good. No, keep going. I get it. It's all making perfect sense to me, and especially the first part, you got to do both. I get it. Go ahead.
So get into the next step where you're talking about controlling costs. You have direct costs and you have indirect costs. Most business owners become lethargic in the way they manage a vendor relationship. Mm-hmm. So instead of competitively bidding against that vendor relationship, we get subtly complacent just out of ease. I'm doing business with vendor A. I like vendor A. I trust vendor A, and vendor A sells me fairly. 2 years later, and you don't realize that vendor A has taken a 2% increase, a 3% increase, a 2% increase, and a 4% increase. All of a sudden, you're 11% higher than when you started with vendor A, and yet you've never competitively bid what they're selling you as you are producing your product. So we advocate, once we have our gross margin set, that you're competitively sourcing every nature of direct costs. So you have labor, you have your material costs, and you have your ancillary direct costs associated with producing your product. Instead of treating it like an ancillary event, I've got my relationship set, I like my relationships, that actually is something that you have to aggressively go at from a maximized production through your labor and through maximizing the opportunities you're creating yourself by minimizing your direct cost. In that, you will get a pretty consistent gross margin. Most companies can achieve, whether that's 30%, 35%, 40%, that number is your own. You have a gross margin that you've been able to consistently been able to perform to. Right. Once I have my gross margin set, you have to consistently look to shave even micro percentages in a gross margin savings directly translate to net profit as long as you're able to maintain the balance of your costs even throughout the year, right? We're talking about overhead.
Yeah, got it. Yeah.
Right. So direct costs, semi-variable expense, variable expense, whereas most people refer to, excuse me, I said that backwards. Really? Semi-variable, variable, and SG&A, right? Variable and direct are usually the same thing. Too technical, by the way, for your listeners? I hope not.
No, they're all going to tune in on this one because everybody gets to deal with it in one form or another. Keep going.
Okay, so once that gross margin, we know that we have our gross margin set. The next equation is your break-even equation, which really determines at what point in your business do your lines collide. In other words, how much gross business do I need to do at a given margin to be able to absorb 100% of all of my other costs in the business to the point at which I generate a margin. Now, I've seen break-even taught a number of ways over the years. I am a diehard believer that break-even is not a moment in time. It is something used as a planning tool not a fixed moment. You don't wait until September 30th to decide all of a sudden you're making a profit. Because if you're managing to a break even and you know what that is, now you can budget effectively, you can strategically plan effectively, you can market your product you can manage your product distribution effectively. You can even motivate the behavior of your sales representation so that they know where that margin is coming from. You can even go so far as to tie your remuneration or performance-based compensation to those cylinders that you've now created for yourself.
Absolutely. And then there's no guessing on it where that moment in time actually is, because sometimes in most businesses, and I want to get some feedback from you, it's an aha moment. Oh, we didn't hit it, or oh, gee, we overshot it. And using your methodology is definitely, it makes more sense to me than, boy, I hope we get there.
Yeah, I always call it the woohoo and boohoo moment. Right? They flip open to that back page, they made money, woohoo! And the alternative, obviously, is the boohoo moment when they realize they are short of that break-even model, right? That looks like a business who's losing money. So when you, and I hope you don't mind my tangential nature, but if I have a client who is consistently underperforming in margin, their industry standard is 10%, and I standard for everyone. But if 10% is good for our anecdotal discussion, and you have somebody consistently performing at 2% or 3%, the one thing I try to get a client to understand to begin with is that 7% that they're leaving on the table. If you have a $3 million company and they're 7% short of that, what I call minimum mandatory standard for the industry. Mm-hmm. In other words, you should not be striving to be average, the best of the worst, or the worst of the best. You should be striving to outperform your standard. You should be working specifically to engineer profitability, because that impacts cash flow. It impacts the equity value of your company. It will affect your retirement. It will affect how much you're able to distribute to yourself in the form of passive income at the end of the year. We would both agree with that, right?
Yes.
So if I have a company underperforming, most business owners look at their paycheck, and they look at how much they're able to take in distributions for tax purposes, although they don't. Most often, Michael, it would shock you to understand that most business owners do not look at distribution as something that they're genuinely entitled to. They may pay themselves $80,000 a year. They may pay themselves $250,000 a year. But on the main, most small business owners take enough distribution at the end of the year solely to cover their taxable obligations for the previous year.
Right.
So on a quarterly basis, if I have a tax obligation of $120,000, then each quarter I'm taking out $30,000, $30,000, $30,000, $30,000. And then you really ask that client how much they made, they don't add, although they go and sit down with their accountant, they don't add that distributive compensation that the company made at the end of the net profit line as something that flowed through to them and that they had to pay taxes on. So they count their wage only. I like to get a client to realize that 8% on a $3 million company is $240,000. That $240,000, relatively speaking, whether you retire debt, whether you keep it in the company, whether you decide to grow your company, receivables grow, inventories grow, that cash flow being produced by a minimum mandatory net profit is what keeps you in a healthy company, continues to grow your equity, and more importantly, I say if you're going to pre-plan profitability, then you should absolutely pre-plan your distributive wage as well. You should be planning for your wealth creation vehicle called your business.
Very well put. Wow. I loved every second of that. It hit home on so many points. All right, Rob. Unless there's anything else, I think that's probably enough for one interview, and we can cover more topics later when you come back.
Absolutely. Was that helpful, Mike?
Absolutely.
I know I can be tangential, my friend. I'm sorry.
If you just see the look on my face, I was in it. That was great.
Okay.
There's so many people on our show could use this information. This is going to be a very, very well, how shall I say, popular interview. I want to thank you for being a guest on the show.
Brother, it's a pleasure every time you invite me. Thank you very much.
You've been watching CEO Money with Michael Yorba. Thanks for visiting with us. Like us on Facebook, follow us on Twitter, and subscribe to our YouTube channel.